Good morning and welcome to the pre-recorded discussion of the Hershey Company's third quarter 2025 earnings results. I'm Honori Naughton, Vice President of Investor Relations. Joining me today are Hershey's President and CEO, Kirk Tanner, and Hershey's Senior Vice President and CFO, Steve Voskuil. In addition to these remarks, we will host an analyst Q&A only session at 8:30 a.m. Eastern on the morning of October 30th. A replay of this webcast and our subsequent Q&A session will be available on the Investor Relations section of our website, along with their corresponding transcripts. During the course of today's discussion, management will make forward-looking statements that are subject to various risks and uncertainties. These statements include expectations and assumptions regarding the company's future operations and financial performance. Actual results could differ materially from those projected. The company undertakes no obligation to update these statements based on subsequent events. A detailed listing of such risks and uncertainties can be found in today's press release and the company's SEC filings. Finally, please note that during today's discussion, we will refer to certain non-GAAP financial measures that we believe will provide useful information for investors. The presentation of this information is not intended to be considered in isolation or as a substitute for the financial information presented in accordance with GAAP. Reconciliations to the GAAP results are included in this morning's press release, which is available on the Investor Relations page of our website. It is now my pleasure to introduce our President and CEO, Kirk Tanner.
Thank you, Honori, and good morning, everyone. I had the honor of joining the Hershey Company as President and CEO in August, but I followed and admired Hershey throughout my 30-year-plus career in food and beverage. This is a rare, purpose-driven company with a long history of enhancing life's special moments, big and small. I'm excited and honored to lead this great company, and I'm grateful to the board, executive leadership team, and colleagues across the company for the warm welcome. 3 months in, my observations on Hershey track closely to what I'd hoped for. Before we dig into results, let me share what I'm seeing across 3 areas: our people and purpose, our iconic brands and robust capabilities, and our strong execution against plans. First, our people and purpose. From the leadership team to the 19,000-plus colleagues worldwide, this team is exceptional. Our purpose, making more moments of goodness, and Hershey's founding values permeate everything we do. There is a commitment to doing right by all of our stakeholders. The Milton Hershey School is a powerful point of pride that brings this to life. I've seen this commitment in countless ways already, and I am confident this is the team that will steer Hershey into the next generation of growth. Our iconic brands play a unique role in people's everyday lives, and that connection drives our success. We have a strong presence in resilient categories and are well-positioned to deliver balanced growth. That is supported by our strong capabilities across areas such as supply chain and manufacturing, retail sales, strategic revenue growth management, R&D, and innovation. I'll come back to that point in a few minutes with an update on the success of our highly anticipated Reese's and Oreo collaboration. And finally, our delivery against plans. We have loved brands in resilient categories underpinned by a strong foundation across the business. But it's our relentless execution that will make our vision of becoming a multi-category snacking leader a reality. The business environment has been dynamic, and I want to commend the team for staying focused and executing against key objectives throughout a challenging year. To highlight a few of these accomplishments, year to date, the team have returned Hershey chocolate retail sales growth to 4% after previous 1% decline in 2024. Increased sweets penetration by 65 basis points through innovation and brand building. Driven mainstream U.S. candy, mint, and gum market share expansion of over 15 basis points. Revitalized Skinny Pop with new packaging, marketing, and price pack architecture that achieved 6% retail sales growth. Secured U.S. pretzel market share leadership with Dots, an expanded share across most key international markets, and responded to inflation with disciplined cost control and expanding transformation effort and strategic pricing. We are benefiting from the positive results of these actions and are pleased with the momentum we're seeing across the business. With that, I'll turn to the third quarter performance. Total Hershey net sales increased 6.5%. Organic constant currency net sales growth of 6.2% was ahead of expectations, driven by strong innovation, strategic brand investments, and market-leading execution. The net impact of acquisitions and divestitures was a 30 basis point benefit, driven by our Sour Strips acquisition. Demand within the U.S. candy, mint, and gum category continues to demonstrate resilience and expandability through innovation and new consumer occasions. Our in-store execution, aisle optimization, innovation, and media and brand investments are contributing to accelerated performance. Hershey CMG retail sales increased 5.4% versus the prior year in the 12 weeks ending September 28th. Retail takeaway growth was led by the non-seasonal business, which increased to 6.6% from 4.7% in the previous quarter, resulting in a share gain of more than 10 basis points. This strong performance was balanced across core brands and innovation, as well as across instant consumables and take-home items. Consumption exceeded category growth in 4 of the top 5 franchises, with Reese's up 7%, Hershey up 11%, Cadbury up 10%, and Jolly Rancher up nearly 30% in the quarter versus prior year. Hershey's Better For You portfolio also contributed with 8.5% growth in the quarter, driven by double-digit growth in our Zero Sugar platform and Brookside. In the third quarter, Hershey products comprised 5 of the top 10 innovations in U.S. confection, reflecting our bigger, bolder, more impactful innovation strategy. Reese's Oreo was the top new item in the category in Q3, and retail sales trends are exceeding our internal targets. Trial and repeat are very strong and in the top quartile across all major manufacturer chocolate innovation in the past 3 years. Moreover, early data shows that Reese's Oreo over-indexes with Gen Z and millennial buyers, a priority audience for the brand. Looking ahead, we plan to sustain engagement and boost awareness with fresh, creative, and partnerships to promote Reese's Oreo across TikTok, Instagram, and live events. Jolly Rancher Ropes, freeze-dried candies, and Shackalicious gummies are also top innovations in the category and expanding our reach into new consumer segments. Our marketing strategies for Shackalicious gummies focuses on raising awareness and authentic engagement with young consumers. Recently, we held pop-up events at Basketball City and other New York City basketball courts, generating excitement and media coverage that spanned from sneaker culture and basketball communities to mainstream TV. We are encouraged by the robust performance of our U.S. confection business into October and the increasingly balanced contribution across our portfolio, which are essential for sustained growth and continued improvement in market share. Our everyday CMG retail sales increased 12% in the past 4 weeks, with double-digit growth across chocolate, sweets, and mints. Although the Halloween season began slower than anticipated, it was likely influenced by factors such as warmer weather conditions and a concentration of seasonal purchases in the final week due to Halloween occurring on a Friday. While Hershey's Halloween performance has been disappointing, the softness is not broad-based across our business. We are using this opportunity to analyze the trends and will adjust our product lineup and marketing strategies for future seasons. Moreover, we remain confident that the seasonal tradition continues to be important to consumers, with the Halloween participation rate expected to be in line with 2024. Our retail teams have been hard at work ensuring that consumers can purchase all their favorite Halloween treats in the final days leading up to celebrations this weekend. We have also added additional investments to support both Halloween and holiday seasons. Finally, our North American confectionery pricing initiative remains on track. Our teams partner closely with retailers to execute our strategic pricing, which is starting to be reflected on shelves. As a reminder, the actions we have put into place did not fully cover the commodity inflation we have experienced over the past 2 years. While we are pleased to see the convergence of our pricing approach with improvement in the commodity markets, based on what we see today, we still have more work to do, as cocoa prices remain up over 70% from 2023 levels. We remain committed to our approach to managing cost inflation through all levers over time. We will also continuously drive productivity to enable investments in our brands and capabilities. In 2026, we plan to increase investments in technology to further strengthen our capabilities across consumer data insights, demand forecasting, commercial investments, and supply chain agility. Turning to salty snacks, our portfolio is well positioned to help meet consumers' growing desire for permissible and better-for-you snacking options. All three of our brands contributed to the 14% year-over-year increases in retail takeaway in the third quarter, resulting in a share gain of nearly 50 basis points in salty snacks. Skinny Pop, ready-to-eat popcorn, and Dots Pretzels are two of the 5 fastest-growing brands among the top 20 salty brands, with retail sales growth of 7% and 13% versus the prior year, respectively. Moreover, Pirate's Booty retail sales increased 11% year-over-year in the quarter, reflecting strong back-to-school performance. The Pokémon partnership and multi-pack expansion were part of that. Puffs is the third largest category in salty snacking, and we see significant opportunity for Pirate's Booty to play a bigger role. Next year, we will refresh Pirate's Booty using the playbook we successfully executed to reinvigorate Skinny Pop in 2025. We look forward to sharing more detail, in addition to exciting plans for Skinny Pop and Dots expansion next quarter. International segment net sales exceeded expectations, partly due to shipment timing, which we expect to reverse in Q4. Constant currency net sales increased double digits in Brazil and Europe, driven by net price realization, innovation, distribution gains, and media investment behind Reese's. Global Reese net sales increased double digits in Q3, driven by strong brand equity investments and activation, including our Halloween partnership with the Scream movie franchise. In Mexico, we continue to see economic and regulatory challenges impacting overall category growth, which we expect to remain a headwind through at least the first half of 2026. Despite the environment, Hershey gained share in Mexico chocolate, and we are executing plans to reinvigorate the spicy candy portfolio. Our 2025 outlook for the segment remains low single-digit constant currency growth. This implies a deceleration in Q4, which reflects the impact of higher price elasticity, category softness in Mexico, and the aforementioned timing of shipments. Next, turning to our revised full-year outlook. Our overall retail takeaway year-to-date, particularly the inflection delivered in Q3, gives us confidence in the underlying trajectory of our business. As such, we are raising our net sales outlook to approximately 3%, up from our prior outlook of at least 2%. We are also raising our full-year adjusted EPS guidance to the top half of our prior outlook. We now anticipate adjusted EPS to decline between 36% and 37%, as our strong top-line results are offset by higher supply chain costs, unfavorable mix, and strategic brand investments. We remain focused on actions that will drive the long-term success of the company and are confident that we will deliver on algorithm top and bottom-line growth in 2026. There is tremendous opportunity for Hershey ahead, and we will remain flexible to invest in areas that we believe will strengthen future growth prospects while continuing to make progress against our commitment to margin and earning recovery over time. I'll now turn it over to Steve to provide you with details on our financial results and outlook for the year.
Thank you, Kirk, and good morning, everyone. Third quarter reported net sales increased 6.5% versus the same period last year. This was ahead of expectations, reflecting strong core performance across all three segments, as well as shipment timing in the international segment. Organic constant currency net sales growth of 6.2% was driven by net price realization of approximately 6 points, along with slight volume growth in the third quarter. Net price realization reflects the combination of pricing announced in 2024 and 2025 and only partially mitigates commodity cost inflation absorbed over the last 2 years. Volume growth in the quarter was driven by North America salty snacks and the timing of international shipments, mostly offset by the impact of price elasticity in North America confectionery and international. North America Confectionery segment net sales increased 5.6% year over year. The Sour Strips acquisition was a 40 basis point benefit. Net price realization of approximately 7% primarily reflects the impact of pricing announced in 2024, with a modest contribution from pricing announced in 2025. Volume declined approximately 1%, reflecting strong performance in the everyday business and innovation-related shipment timing, which partially offset the impact of price elasticity. North America Salty Snacks segment net sales increased 10%. Volume growth of approximately 11% reflects growth across Dots, Skinny Pop, and Pirate's Booty, as well as incrementality from Reese-filled pretzels and variety multi-packs, which more than offset planned reductions in private label production. Net price realization was down approximately 1%, reflecting the timing of customer programming. International segment net sales and organic constant currency net sales both increased 12.1%. The impact of foreign currency translation during the third quarter was negligible. Net price realization was approximately 7%, reflecting strategic pricing initiatives across key markets. Volume increased around 6%, driven by an approximate 5-point benefit from the timing of shipments, which we expect to reverse in Q4. Excluding this benefit, volume was above expectations, primarily reflecting strong growth in Brazil, Europe, and our global Reese's expansion, which was partially offset by the impact of price elasticity across markets. Moving down the P&L, adjusted gross margin of 31.8% decreased 850 basis points year over year in the third quarter. Commodity inflation, incremental tariff expenses of approximately $65 million, and unfavorable mix were only partially offset by higher volume, net price realization, and productivity and transformation program net savings. Gross margin was higher than expected due to the timing of cocoa hedges and earlier than planned net price realization. Advertising and related consumer marketing decreased 5% from the prior year in the quarter, primarily reflecting reduced agency fees and efficiencies in North America Confectionery, which were partially offset by increased investment in the North America Salty Snacks and International segments. Adjusted operating expenses, excluding advertising and related consumer marketing expenses, increased 5%, driven by higher incentive compensation and consulting fees, partially offset by transformation program net savings. We remain on track to deliver an incremental $150 million in net savings this year as part of our AAA program, to be realized across cost of goods sold and selling, marketing, and administrative expenses. Interest expense was $51 million in the third quarter, in line with expectations. Our full-year outlook for interest expense is now approximately $195 million. The adjusted tax rate for the quarter was 26.7%, up from 15.2% last year, driven by higher levels of renewable energy tax credits in the prior year period. We now expect a full-year adjusted tax rate of approximately 26%, with other expense of approximately $30 to $35 million. In the third quarter, capital expenditures, including software, were $86 million, $42 million lower than the prior year period, as we lap investment in capacity expansion projects that have since concluded. We expect full-year capital investments of approximately $425 million, reflecting improved visibility to ongoing projects. Dividends paid to shareholders in Q3 totaled $271 million. The company did not repurchase any shares in the third quarter against our December 2023 $500 million authorization, of which $470 million remains. Let me summarize our outlook for full year 2025. Based on year-to-date performance and visibility into Q4, we are raising our full-year net sales outlook to approximately 3% growth, up from at least 2%. Net price realization for the year is expected to be between 5 and 6 points. Regarding tariffs, we are now modeling tariff expense in the range of $160 to $170 million, a $10 million reduction, reflecting lower Canadian retaliatory tariffs, partly offset by fluctuations in other country-specific rates. Adjusted gross margin is expected to decline approximately 675 to 700 basis points in 2025, in line with our prior outlook, as the higher sales outlook and improvement in tariffs are offset by higher supply chain costs, unfavorable mix, and strategic brand investments in Q4. For the fourth quarter, we expect adjusted gross margin to decline more than in Q3, as higher cocoa costs, tariff expense, and the timing of hedges are only partially offset by incremental net price realization. Adjusted earnings per share is expected to decline in the range of 36 to 37%, the upper half of our previous range. Before I turn it back to Kirk, let me touch on cocoa and 2026. On cocoa, we are encouraged to see cocoa financial markets beginning to respond to improving fundamentals. We're optimistic that the recently announced farmer price increases in Ivory Coast and Ghana will further encourage farm investments. This is an important step, together with the industry's sustainability commitments, to assuring the long-term supply of cocoa while enhancing the livelihoods of cocoa farmers in these countries. Meanwhile, the supply of cocoa from other origins continues to expand. Our robust internal models continue to project a bigger global supply surplus for the 25 and 26 crop than the prior season, as global supply returns to the long-term trend and end users continue to adapt to higher prices. The Q3 global grind, a measure of demand, was down 13% year over year, the 10th straight quarter of mid-single-digit or greater declines. While cocoa futures have retreated, based on what we know today, we continue to forecast cocoa inflation in 2026. This reflects our robust hedging program, which locked in prices well below the market in 2025, and the coverages we have placed for 2026. If cocoa prices continue to retreat, we are able to participate in some downside, but our overall hedging program is designed to provide visibility and reduce volatility in market prices over time. While the long-term outlook is brightening, based on what we see today, we will continue to manage through the commodity cost inflation and tariff expenses we've absorbed over the last 2 years, which are not yet fully recovered by recent pricing actions. We recognize that the marketplace will continue to be dynamic and evolving in 2026. Our agile and dedicated team continues to deliver on our key initiatives while supporting investment in our brands and capabilities, which gives us confidence in delivering balanced top and bottom line growth in 2026 and beyond. I will now turn it back to Kirk for closing remarks.
Thanks, Steve. I'm excited to steer the next generation of growth at the company, working closely with our talented team members, valued customers, and the board. Together, we'll focus on delighting consumers and delivering results as we unlock our full potential as a snacking industry leader. I look forward to sharing our strategic plan and vision to further advance Hershey's snacking leadership at our 2026 Investor Day.
Good morning, everyone. Thank you for joining us today for the Hershey Company's third quarter 2025 earnings Q&A session. I hope everyone has had the chance to read our press release and listen to our pre-recorded management remarks, both of which are available on our website. In addition, we have posted a transcript of the pre-recorded remarks. At the conclusion of today's live Q&A session, we will also post a transcript and audio replay of this call. Please note that during today's Q&A session, we may make forward-looking statements that are subject to various risks and uncertainties. These statements include expectations and assumptions regarding the company's future operations and financial performance. Actual results could differ materially from those projected. The company undertakes no obligation to update these statements based on subsequent events. A detailed listing of such risks and uncertainties can be found in today's press release and the company's SEC filings. Finally, please note that we may refer to certain non-GAAP financial measures that we believe provide useful information for investors. This information is not intended to be considered in isolation or as a substitute for the financial information presented in accordance with GAAP. Reconciliations for the GAAP results are included in this morning's press release. Joining me today are Hershey's President and CEO, Kirk Tanner, and Hershey's Senior Vice President and CFO, Steve Voskuil. With that, we'll open it for the first question.
Thank you. Our first question is from Andrew Lazar with Barclays.
Great, thanks. Good morning, everyone, and welcome, Kirk.
Thank you, Andrew. Good morning.
Morning. Maybe to start off, I'd love to dig in a little bit deeper on your commentary around 2026. Company's looking for an on-algorithm top and bottom line year. This is consistent, with the commentary you provided last quarter. Since then, cocoa costs have moderated significantly, even though Hershey still looks for year-over-year inflation. Company slightly lowered its tariff estimate, and base momentum certainly appears to be continuing, if not accelerating. I think in the prepared remarks, you make mention of sort of earnings recovery over time. And in fairness, you still need to see what elasticity looks like as the pricing flows through. So I guess I'm just curious how you sort of balance these various factors as you think through how next year could shape up. Because, as you know, there are some expectations out there for maybe much more significant year-over-year EPS growth next year.
Yeah, thank you, Andrew. I think that it's an important topic to get the morning started. Yeah, if I think about 26, I look at where we're at right now. So the momentum in the business right now, I'm really delighted with the balanced growth that we're seeing across our portfolio. So I feel good about that before going into 2026. And I think it's important as you take that momentum into 2026. I think defining what success looks like is really important for us for 2026. And for me, that is looking at where the category is and how we're growing with or ahead of the category while we build back that margin to its full potential. Now, we won't do that just in 1 year, but we'll do that over a few years. But it's really important that we grow and we are doing exceptional at the category level, building back margin. And so what does that do? It puts us on our long-term algorithm. That long-term algorithm in the top, from a revenue standpoint of 2 to 4%, that is sensible. We think that's where the category is going to be. Now, in a shorter Easter category, generally, from a historical standpoint, it's been around 2%. So when you think about the top line, that's where we land. Now, on EPS, back on algorithm, I would say there is some potential for some upside. But we do all this in 26 with the approach of playing for the long term. So we're going to we're going to invest in our business, we're going to invest in our brands while we build back margin and compete at the category level. That is success for us in 2026.
That's really helpful. Appreciate that. And then just quickly, I know it may be far too early to really opine on this with any accuracy, but I guess what are you seeing thus far from an elasticity standpoint? I know there's more pricing still to flow through. And I guess what's your expectation for elasticity in the context of your guidance for next year? Thanks again.
Sure, I'll take that one. I mean, it's early days, and so we'll know more the next time we talk. The category continues to be rational, and everything we see so far, nothing gives us concern or is deviating from our expectations. Most of our pricing is reflected, as he said. Other competitors' pricing still flowing through. We saw early in the year other competitors taking prices. We saw premium go up. We saw private label go up. And so everything that we're seeing as our pricing has come to shelf is lining up within expectations. As you said, next year, that elasticity is a big assumption. And I know we've had some folks who said, well, are you being a bit cautious or conservative in the way you're thinking about that elasticity as we planned it at -1? But we feel like it's an appropriate kind of center cut as we look at the plan for next year. This year, it's been running a bit better with the price increase that we've taken into this year. But this year also has a few positives coming along, whether it's the long Easter, the merchandising benefits that we had early in the year, the significant innovation benefits. And so when we adjust for those as we think about 26, we think that -1 is the right place to plan from. So, but we'll be watching the space closely. Nothing at this stage gives us concern.
Thanks so much.
Our next question is from Max Gumport with BNP Paribas.
Great. Thanks very much. Just following up on that elasticity response, and I realize it's early, but if you can just focus on the everyday business and give us a bit more color on what you're seeing in these first few weeks, particularly given the comments around double-digit growth across the everyday business over the past quadweek, what you think that means for elasticity. Realize it's early. Realize you're planning on the -1, but just any incremental color that would be helpful. Thank you.
Yeah, I would just say again, no concerns on what we're seeing so far. If you look at everyday CMG where the price increases hit, we're up double digits in the last four weeks. So feel good about what we're seeing so far. But more to play. We'll have more to say the next time we talk.
Great. And then on competition, I think there's been a narrative that some competitors are not following, and you just touched on this, but when I look at the data, it's not as clearly that's the case. I think if you look at your largest branded competitor, while their pricing might not be as high on a year-over-year basis, it looks like perhaps you two are simply moving at different cadences, with them moving harder earlier in the process. I think if you go back to where you all were 4 years ago, it looks like you're actually still just catching up on pricing relative to that period. So with that backdrop, I'm hoping you can provide a bit more color on what you're seeing in the competitive pricing environment right now. Thanks very much.
Yeah, look, I think that's an important point, and had the opportunity to look at the competitive landscape and look at our pricing cadence as it relates to I think we put the most important thing for us is we put the consumer first. We look at our business. We do it on the cadence that makes sense for our business and our consumer, and we were working with our customers to make that happen in the most deliberate way, so that we can continue to deliver for our consumers. And that, I think, is really important. Now, the cadence, is probably a little different from historic purposes, but I look at it from what is the best solution for the category, our consumer, and, for our business.
Yeah, and a pretty significant part of our price increase, and you mentioned this, was catching up to what happened earlier that competitors have done. So, there was a time in history where everything moved in lockstep. Now I think everyone is more precise, more strategic as the way they execute pricing, and it leads to different phasing. But overall, we're not concerned about price gaps across the portfolio.
Yeah, and I would say, one thing to look at is this category has been very resilient and rational. I think that's really important when you look across the industry. That gives us the confidence that we're making the right decisions, and we don't have concerns at this time.
Great. Thanks very much. I'll leave it there.
Our next question is from David Palmer with Evercore ISI.
Yeah, good morning. In the prepared remarks, you noted Halloween's been disappointing. Love to get some color about how much is by what sort of level has it been disappointing, and you've noted Friday Halloween, warm weather. Have you seen similar headwinds with those types of dynamics to what you're seeing here, or do you reflecting on this? Do you think there might be something going on with the consumer, the customers, in terms of their focus on the seasons, the competitive environment? And then relatedly, you said that you're using this opportunity to analyze the trends and to adjust the product lineup and marketing strategies for future seasons. So just curious about what you're thinking as you reflect on this so far.
Yeah, David, thank you for the question. I think it's certainly timely. I'd start with, we're pleased with the strength in the overall business with more balance across our portfolio. And, we mentioned our everyday CMG business is growing double digits the past 4 weeks. So there's certainly some interplay that we typically see. We'll say the season did get off to a slow start. And I think you have to look at historically when Halloween falls on a Friday, about a third of the business is sold the last week. So I think it's really important. Having said that, yeah, there's some opportunities for us. I would say it's not broad-based, but there's some opportunities for us to go to school on the consumer insights, our customer insights, so that we can improve on every season, including next year's Halloween. So we will look at pack types, offerings, opening price points, product mix, all that through the lens of the consumer. Yeah, I think this is an opportunity for us to go to school and get better with each season.
And just to follow up on, you noted that cocoa is going to be inflationary in 26. Does it feel like retailers are sympathetic to where you are with your pricing and your input inflation? You seem to have, hedged very well in 25. Maybe somebody didn't out there, and their timing of their pricing might be mismatching yours. And so I'm wondering if there could be some noise out there with regard to competitors and other pricing actions that could affect near-term results. And I'll pass it on. Thank you.
Yeah, no, thanks, David. I think it's really important, one, that we have relationships of trust with our customers, and building those are critically important to me and our entire organization. We have that customer mindset, and with this pricing, we have worked hand in hand with our customers to find solutions to meet consumers where they are. I would say, from a cocoa standpoint, it's still 70% higher than it was in 2023. So I think that just grounds us all in where cocoa is today. I know we're optimistic with some of the movement recently, but if you just, look back, that's really important to understand. But I'd say, with pricing, very planful approach. I have a fresh set of eyes on our approach and our communication to customers, our partnership with customers, and I've had the opportunity to talk to a lot of our customers myself. And that is something that's really important that we get that right with our customers.
Thank you.
Our next question is from Leah Jordan with Goldman Sachs.
Good morning. Thank you for taking my question. I wanted to ask about innovation. It's obviously been working well this year, especially in the back half here. So as we look to 26, could you provide some color on how you're thinking about the pipeline there? What are the key focus areas? And how are you thinking about balancing growth in the core versus innovation into next year, especially as we're kind of lap some strength here in the back half?
Yeah, I think that's a really good question. And innovation is so important to the category. Consumers are continuously looking for it. The recent innovation that we put out with Reese's Oreo has been really the top driver of growth from an innovation standpoint in the category. So something to look at and be excited about. But when I step back from that, I look at our core business, even in Q3, where our core business was, close to 5% growth without Reese's Oreo. And, that says something about the balance of what we expect. Now, we're going to have the benefit of most of next year with Reese's Oreo, and we'll continue to build on that momentum and find exciting ways to connect consumers with that innovation. Having said that, we have a robust pipeline in 2026 of innovation and 2027. So we feel like we're building this pipeline of innovation because that's, again, engaging with consumers is important, all while balancing your growth with your core business. I think that is really important. And that's kind of how we see this. We cannot rely just on innovation to drive our business. It's a balance between the two. And if I look at Q3, we have struck that balance with a really good innovation.
It's very helpful. Thank you. And maybe just a quick follow-up here. It sounded like there was increased brand investments in the quarter. Maybe you could just talk about where you're making those investments and what you're seeing in the competitive environment broadly. And do you see a need to make more investments just in the current environment? Thank you.
Yeah, I think it's important to invest. I think there's a smarter way to invest in brands as well, right? So there's a more efficient way to invest in brands. I think that obviously with Halloween and the holidays, we've invested in some digital marketing to drive performance, drive flow through, etc. But we'll continue, and I would say we've had some fun with some innovation with Reese's Oreo as well. So those investments have given us some momentum and really are on strategy for how we think about our business going forward.
Great, thank you.
Our next question is from Megan Clapp with Morgan Stanley.
Hi, good morning. Welcome, Kirk. Thanks for taking my question. I wanted to come back to the commentary on 2026 and Andrew's question at the beginning. Last quarter there was a comment on the call that there were multiple paths to EPS being well into the double-digit range in 2026. I think the biggest factors mentioned at the time were what happens with tariffs and cocoa costs. And understand, Kirk, I think you said there's still upside to the algo, but as you think about some of those puts and takes today, would you say that anything has changed that would affect that view? Cocoa's obviously come down. Maybe you're a bit more covered for 2026 though at this point, and broadly any visibility on potential tariff relief as well. Thank you.
Yeah, thanks, Megan. Again, to comment on the potential upside for EPS, I'll let Steve kind of go through the puts and takes that you asked. Thanks for the question, Megan.
Yeah, as Kirk said earlier, above algorithm performance definitely on the table. There's a handful of things that we're going to be watching really closely, especially as we finalize the plan. Consumer demand, of course, the health of the consumer right now, big focus. Right now, we're optimistic on that for next year, but we'll be watching that. We talked about innovation. Feel really good about our innovation. Oreo continuing, a lot of tentpole events next year, so we think that's going to be a big year for innovation. Elasticity, of course, as we touched on in the question earlier, and then as you said, cocoa and tariff relief. We're feeling marginally better about cocoa. I think when we talked last time, since then, it's moderated a bit, and we're in the process of layering in our hedges according to our program, and we'll have more visibility when we talk next time. But net, feeling a bit better from a cocoa standpoint. And tariffs, ongoing changes week to week. I think, the first prize we were hoping for, a blanket exemption, is probably not in the near-term cards, but we've seen significant acceleration on trade deals. And so now that cocoa and other commodities we can't make here are part of that third annex, as those deals come in, we're optimistic we could see some positivity there. For now, we've modeled, $200 million incremental on tariffs and still have in our model cocoa inflation for next year. But I would say that level of inflation is moderating, and we'll know more when we talk next time. So overall, Great. Not that much different from last quarter, other than maybe a little bit more optimism on tariffs and cocoa.
Awesome. That's super helpful. And then maybe just more near term on the implied 4Q. It does seem like most of the increase in the full year top line guide was driven by what you saw in the third quarter. I think depending on rounding, implied 4Q is maybe a little bit below where the street's modeling. Maybe part of that's due to the international shipment timing. But could you just maybe give us, what you're expecting for the fourth quarter explicitly, and whether the outlook for North America confectionery has just changed at all, just given the puts and takes between Halloween and everyday? Thanks.
Sure. Yeah, most of that impact is international shipment timing. From a U.S. CMG standpoint, we see the momentum continuing. As Kirk said, we're directing some additional investment to help Halloween sell through and performance, and also get holiday off to a good start. So that's a little bit why the EPS doesn't follow the sales on the back half, or the guide up on EPS is a little softer than it is on the top line. But we also have watched, as we always do, the timing of cocoa hedges, which was a favorable for Q3. We're not expecting quite that same level of favorability as we close out the year. So, but yeah, on the top line, that international timing is probably the biggest thing. We expect CMG momentum to continue.
Awesome. Thanks, Steve.
Bet.
Our next question is from Tom Palmer with J.P. Morgan.
Good morning. Thanks for the questions. I'm going to maybe stick to Halloween for a second. You noted the slower start to Halloween, and that when Halloween falls on a Friday, there can be this last week waiting. If we do get a third of your Halloween sales in the last week, would it be more on track with how you're thinking about it, or do you need even more of kind of a disproportionate catch-up when we think about this year? And I, in particular, want to make sure how this relates to kind of what's embedded in guidance. Thank you.
Yeah, I think that, to get straight to it, I think it still would be somewhat soft. I think that we would walk away saying that Halloween by itself is going to be a little soft in this season. I do think the interplay between our core brands is happening, and we're seeing some of that in the insights that we're looking at. I think that's obvious. We also have a big innovation out there, and we have core packs that are performing well. So the interplay between Halloween, the season, and our core packages certainly is something we're going to school on, and we can talk about later. But let's see where the week comes in, and then we will share the insights and some of our action plans moving forward. But winning at the season is critically important to us, and we continue to build on our capabilities, through insights and the actions that we need to do to move the business forward.
Okay, thank you for that. And then just, look, I think on the cocoa commentary, I want to clarify, one, at some point next year, your cocoa costs likely turn deflationary, even if they're up for the full year. And I'm curious your views on pricing as inflation eases. I don't think you've historically given back pricing, but we are facing kind of unusual levels of both inflation and potentially deflation. So wanted maybe a clarification on how you're thinking about it this time. Thanks.
Sure. On the first part of your question, the expectation right now with where cocoa is, I would hope as we get deeper into 26, we'd start to see some deflation. Again, we'll have a better picture of that profile when we talk next time, but just based on what we're seeing right now and looking year over year. And again, giving back price, I got to start with a comment from earlier. We're still seeing cocoa up 70% from where we started the cocoa inflation journey. And so, we haven't fully recovered from that. And again, pricing's not the only lever. We are driving the transformation program. We're driving savings. So we will continue to use every lever at our disposal to do that. But at the same time, we want to make sure that we're investing in our brands and that we're driving good partnership with retailers and making sure we're helping to, again, grow at or above the category. So we're going to have a focus on balanced recovery, as Kirk said earlier.
Understood. Thank you.
Our next question is from Peter Galbo with Bank of America.
Hey, good morning, Kirk and Steve. Thank you for the questions. Steve, not to belabor the pricing dynamic point again, but I do think some of the hesitation maybe is stemming from the fact that one of your peers operating in Europe kind of talked about a need maybe to solve some price gap issues. You obviously have a peer that competes both in the U.S. and Europe, so the translation of that dynamic happening in Europe back to the U.S., is there kind of a future where the same thing happens? So maybe it would be helpful just compare and contrast just the structural factors that might make the U.S. market where you operate different from that pricing standpoint. And I think that would help clarify a bit of the fear that's out there that, hey, there's all this pricing that's coming in the market, but with cocoa coming down, are they really going to be able to kind of hold through? Yeah, you bet. So I do think it's two different markets, and I think we have to be careful kind of taking the assumptions from one and applying them to another. The U.S. category, CMG has been very resilient, it's been very rational, and we just aren't seeing today any major price gaps that are causing us concern. Obviously, we're watching consumer health. We're partnering closely with retailers to make sure that the category stays healthy and growing, and we want to be part of that with our innovation and brand investment, et cetera. But it is a different situation here than what you're seeing in Europe, and that rationality here, I guess we have no reason to believe that's not going to continue based on everything we're seeing even in the market right now. Great. Super helpful and clear. And maybe as a follow-up, Steve, I actually wanted to ask on international. I know you had the shipment favorability dynamic, but it was actually a loss-making quarter in that business. So I guess just applying that forward, right, if you don't have the favorability on shipments in Q4, should we be expecting, the next couple of quarters that you might still be playing catch-up to get back to profitability, or how we should think about that segment specifically? Thanks very much. It's a great question. We don't always have time to talk about international. I think, it's a challenging market because a lot of our business in international is cocoa-driven and even cocoa-intense in some markets where the percent of cocoa is part of the advertising. And so
it feels more the brunt from cocoa. It'll also eventually feel more of the recovery when we get to the other side. We've been more aggressive on pricing in international, but because we're a smaller player in some of those markets and our products are positioned in a more premium way, the elasticity impacts are also more severe than what we model here in the U.S. That said, we're optimistic on the business, and in fact, we're growing share in all but one probably of our core markets right now. We feel good about that. We've had great results in Brazil, and profitability isn't there right now, but we still are optimistic about the market and our ability to grow and eventually return to profitability. So despite the numbers, we're optimistic on the future, but we have to work through the cocoa challenges there a little bit more intensely than we do here in the U.S.
Great. Thanks, guys.
Our next question is from Jim Salera with Stephens Inc.
Good morning, Kirk, Steve. Thanks for taking our question. I wanted to maybe shift gears a little bit and ask on salty snacks, given the strong performance you guys saw there. I think you mentioned in the prepared remarks, you did 14% year-over-year increase in consumption, saw share gains in salty, particularly driven by volume, which is in pretty stark contrast to a category that's been, anemic kind of at best this year. Can you just walk us through what are kind of the driving factors there, and maybe any commentary on 4Q about how we should think about that business kind of closing out the year and anything we should be aware of maybe on the innovation side?
Yeah, Jim, thank you for the question. Look, our salty business, I'm really excited about this. We continue to build capabilities with our salty team and our salty business. And I look at where we are in the category with our brands and how important that is. So with Skinny Pop leading in the popcorn category, it, of course, went through a refresh. It's got a new look, and it's delivering against growth. It's also, we're working on portion control, and multi-pack is working. So we see a lot there. But, again, it's grounded in permissible snacking, premium snacking, and that makes a difference. When I look at our pretzel business in Dots really has made an impact on pretzels. Now, Dots is the leader in the pretzel category. For a young brand, that's pretty impressive. It's hitting on a lot of marks with consumers. It is definitely in the right place in the category, and it's helping the category grow. And then I think we still have a lot of opportunity with Pirate's Booty. It's in Puffs. Puffs is the third largest part of the category, and we're just scratching the surface. So it's over a $4.5 billion category. We have an opportunity to play in that with a mom-preferred, loved brand. So the collection of brands that we have in the right places with permissible snacking allow us to grow ahead of the category. We'll continue to build on that momentum. We'll continue to look to our salty business to scale that and, build our capabilities. But, having a lot of experience in this area, I'm really optimistic of where we can take the salty business.
Great. And maybe just any commentary you could provide on innovation and to the extent that you can maybe point us in a direction, for 4Q. I mean, should we expect kind of continuation of where we're at now, acceleration? Just any thoughts around that to close out the year?
Yeah. We see the same, the momentum moving forward into 2026. We have some innovation on Dots that I'm really excited about. We also have innovation on Skinny Pop. Across the portfolio, we've looked at multiple areas across kind of all three brands actually, and there is a pipeline of innovation across our portfolio. So, more to come on the launches of the innovation, but we have a pipeline that'll drive growth and delivery, and there's some exciting things across Dots, Skinny Pop, and Pirate's Booty.
I appreciate the color. I'll hop back in the queue.
Our next question is from Robert Moskow with TD Cowen.
Hi, thanks for the question, and welcome, Kirk. Two questions. One is, Steve, when you're giving the factors that might determine whether there's double-digit potential, you mentioned several. But is it fair to say that elasticity is probably the biggest and most determining factor? And since it's hard to predict, would you consider providing a wider range than normal for 2026 guidance to take that into account? And then I had a quick follow-up.
Sure. Yeah, great question. I would say elasticity probably is the biggest. I mean, obviously, cocoa is huge as well, but elasticity is one we'll be watching very closely. From what we see now, like we talked about earlier, not concerned, but we'll be watching it closely. On the range, it's an interesting point. I think that's something we'll give some thought to between the time here and giving guidance. Depending on what we'll see. I think we will see more on elasticity. We'll have a better view of cocoa by that point. Maybe tariffs, maybe not, but it's a good point. Something we'll probably think about.
Okay, thanks. And in doing a deeper dive into these price gaps that emerged, what we really found was some pretty sizable ones in king size in the convenience channel after you raised price between you and your biggest competitor. But I think your competitor raised prices since then. So is it fair to say that gap does exist, but it's just kind of temporary and it'll close soon?
Yeah, I would say I don't want to get down to pack type by pack type retailer sort of detail. But like I said, we have all of that. We've seen what you're talking about on king size. We look at every packing, every retailer. Right now, there are some gaps in places. Some of those gaps are closing. Some of those gaps may hang around for a while, but as we look at them in the aggregate, there's nothing that's concerning us at this stage. Recall, there is this sort of give and take, and we talked about it before about the cadence of, the follow can take a little while. Sometimes we choose to take a little while to follow. And so this is part of the category, which is still rational. It just doesn't fall in a perfect cadence all the time.
Great. Thank you.
Our next question is from Alexia Howard with Bernstein.
Good morning, everyone, and thank you for the question, and welcome, Kirk. Can I ask about the C-store channel? I think Rob mentioned it. It seems as though you were having some trouble with that earlier in the year. It seemed to be in recovery, I think, over the last few months. Is that still going fairly strongly at this point? And then I have a follow-up.
Yeah, thank you. I appreciate the question. I'm really passionate about the convenience channel. I just had the opportunity to be at NACS in Chicago and talk to a lot of our customers. Look, I think about the performance of the category in convenience right now, and CMG is performing at a +6, so pretty healthy cadence in CNG right now. I think there are still some opportunities for us to get stronger, and we are hyper focused on IC and our ability to execute, and we've rolled out these gold standard merchandising plans. We've built this innovation pipeline. We're building on tentpole moments, all with the lens of delivering for our convenience customers. So there is a level of intensity that we're putting against the convenience channel, because we know it is a priority. We know IC is a real priority for us, as it's a big brand builder and an area where we can continue to grow our brand. So we're going to show up strong. We like the momentum that we have. We still think there's opportunity for us to get better, and we'll do all that with the partnership with our convenience customers.
Thank you. And as a follow-up, there's been a lot of questions on innovation. Are you able to put any numbers around that in terms of percentage of sales from new products introduced either over the last year or last 3 years, and how that's ramped over time? Because it seemed as though innovation dropped off in the years immediately after the pandemic. Thank you, and I'll pass it on.
Yeah, innovation is such an important lever for sure, but I think being consistent with innovation is also important in balance with your core business. I tell you one thing that I really liked about this last innovation that we launched with Reese's Oreo, especially in convenience, as we're talking about that channel, is we co-merchandised it with our core brands, and we saw our core brands elevate with innovation. And I think that is just a testament to the execution that we have in the market marketplace, not just highlighting our innovation, but bringing our core along with it, I think is a really good thing for us to do. It's a fundamental that we believe in. And so that, I think, takes, the total portfolio into account. I think innovation is critical. Consumers are looking for it. But if it can help build your core brands as well, I think, you're in a much better place.
Thank you. I'll pass it on.
Our next question is from Scott Marks with Jefferies.
Hey, good morning. Thanks so much for taking our questions. You've made some comments today about monitoring the consumer health, and I think we've heard from some of your peers about more broadly just weakening U.S. consumer sentiment. So just wondering if you can share with us your thoughts around what exactly you're seeing with the consumer and how you're thinking about that as we head into the holidays and 2026.
Yeah, I think that's an important topic, and I've had the opportunity to talk to a lot of our customers as well. I think the consumer certainly is continuing to be challenged. It's a challenging consumer market, and there's a lot of headlines that have been talked about driving that concern. But I would say our category remains resilient. I think that's an important thing to think about. So the impact of consumers, how that interacts with the category, and how it's reacting to our business. I think those are the dynamics we look at. But I would say, large part, the consumer certainly under pressure. Our category is showing up resilient, I think, really importantly. And then as we look into 26, we see the category running at historic levels with those pressures. So I feel really confident about where we're at in light of a challenged consumer.
Appreciate that. Thanks. And then just a follow-up question. We've also started to hear from some of your peers about expected headwinds from changes to the SNAP program, both policy changes, which could be more structural, and then maybe more temporary government shutdown-related issues. Just wondering if you can share with us some context around how you're thinking about potential SNAP headwinds for the business. Thanks.
Yeah, I think it's an important one. Again, a live discussion that we've had with our customers and understanding the impact overall of SNAP. If you just take a step back and look at SNAP, about 2% of SNAP dollars are in the category, the CMG category specifically. Right now, we've seen, I would say we haven't seen a large impact, but it's early days. I think if you look into 26 with the dynamics between the state and the federal government on SNAP, we expect it to be a minimal impact right now on the category, but it's something that we're continuously watching and trying to understand. I think it comes down to the behaviors of consumers that are in the SNAP program and how they choose to spend those dollars, but we will stay close. But I would say in 26, it will have a minimal impact to the business from what we're seeing right now.
Appreciate it. Pass it on. Thanks.
Our next question is from Michael Lavery with Piper Sandler.
Thank you. Good morning, and thanks for the question. Just wanted to come back to cocoa, and you said that you could get some benefit if costs fall further, but it sounds like you're maybe also a bit decently committed and that you're focused with your hedges on visibility and less volatility. Maybe could you just give a sense of how wide a range is still ahead of you? You're forecasting it to be inflationary. That might moderate a bit, but would you be positioned such that it wouldn't be deflationary, or just maybe give us a sense of how wide a range of possibilities are still in front of you?
Sure. Yeah, I'd be happy to. So the fundamental hedging program, as you said, Michael, hasn't really changed. We're hedged, I would say, to the normal level we would be at this time of year, given that we still believe, cocoa does have some room to fall based on the fundamentals that we've talked about in the past. And so, right now, as we see it on a full year basis, we see it inflationary, but there is a possibility of deflation. And the way we've structured our program, as many do, we have a mix of some things that are price fixed and some things that allow downside participation. And so between the unhedged portion looking forward and downside participation, there is potential if we continue to see some fall in cocoa that we could see some deflationary. But it just a lot depends on timing and the magnitude.
Okay, that's helpful. And you've said in the past that around 75% of your portfolio is less than $4. I guess, how does that look after this latest pricing? And then is that sort of the key threshold? We hear $3 from some other snack peers as maybe a key focus point as well. Any sense of maybe kind of where you are sitting today relative to maybe either one of those thresholds?
Yeah, I think that 75% of our units are below $4. I think, it's an important to understand where consumers are with price points and, with the offerings that we have. But I would say that that's largely the case today.
Okay, great. Thanks so much.
Our next question is from Chris Carey with Wells Fargo.
Hey, good morning, everybody.
Good morning, Chris.
We are late in the call, so I'm just going to ask a couple clarifying questions if I could. Just on, this, conversation around algorithm, for next year, kind of similar commentary despite the lower cocoa. Is it fair to say that, if cocoa had not come down, you probably would have to take even more pricing in the next year, and now you're basically not in that situation anymore? And then, go ahead. Go ahead.
I was going to say, no. I don't think at this point we're not focused on pricing. We've got the price increase we've just announced rolling through, but we continue to work all the other levers as well, whether cocoa goes up, down, or sideways in terms of productivity, driving our transformation savings, continuous improvement, et cetera. So right now we're focused on continuing the momentum in the business and making sure that we have the good execution on the pricing that's already in the market and focused on a balanced approach to driving the business for the long term.
Great. Is it fair to say that if cocoa did not fall, you would have to assess whether additional pricing would be needed? And then just a quick clarification there. And then I think the tax rate came up. Obviously, there's been a sort of reorientation of tax rate. Can you just give a sense of what's going on there and, medium-term tax planning and opportunity? Thanks.
Sure. So just back to the first question. In 26, we would not anticipate taking more prices, even if cocoa, remained at prior levels. Now, long term, again, we have to manage over a long window. So to be on algorithm, we would continue to look at pricing as a long-term lever, but not for 26. Hopefully that helps. Again, cocoa, we're still executing and making sure the price increases that we've announced flow through. On tax rate, happy to talk about it. It's been a bit of a change this year. In fact, it's probably been a topic every quarter. And we have a couple things that are happening, a couple of which are unusual to this year and one that we're still working through for next year. But on one hand, we have three things hitting the tax rate. One, some adjustments in reserves based on some legacy positions and legacy litigation. We didn't have any of that in the third quarter, but you recall in a couple of earlier quarters, we talked a little bit about having some reserve adjustments. The second piece is related to some procurement strategies. So earlier in this year, as we looked at different sourcing alternatives for cocoa, which we pursued, drove great ROI, but had some less tax efficiency than our normal procurement strategies. And then finally, the tax credit strategies, which we've talked about. In the current environment, we just haven't found as many attractive tax credit investment opportunities. Again, we've got ROI thresholds, quality thresholds, and with the movement in the investment universe for those, they just haven't been as attractive given our thresholds. So those are the three things that have been impacting tax rate for this year. We'll give more guidance on next year's tax rate and some of the factors there when we get to guidance later.
Hey, Chris, I just wanted to share my point of view on 26 and the pricing questions that you asked. Look, I think, if you go back to what we talked about, what 26 looks like from a success standpoint, certainly getting back on algorithm. We talked about the potential for EPS. But I think that it's really important to get this message across so we retain the flexibility to invest in our business. We're playing this for the long haul. We have a lot of energy and enthusiasm in the business right now. We want to keep that momentum. There's also a lot of great new ideas to drive growth and health for the business over the long term while we recover our margin that we've gone backwards on. So I think that balance, is what I would leave you with, is we still have that flexibility. We're enthusiastic about what we see with momentum, but also the opportunities we have to invest in for the future. So certainly a balance of how we build the business.
Thanks, guys. I appreciate it.
Our next question is from John Baumgartner with Mizuho Securities.
Good morning. Thanks for the question. Maybe just sticking with convenience stores, Kirk, just bigger picture, I'd like to hear your observations of the retail landscape for competitive merchandising and promo, just having seen it in your seat across multiple categories over the years, how promo merch has evolved given the rise of smaller brands, healthy snacks, non-CMG categories. Just how has competition changed for that high visibility merchandising? How do you see confectionery positioned today to compete? And are there any changes you think Hershey can make in terms of either existing spend levels or types of promotion?
Yeah, I think that's the right question, and I think it is changing. I think, John, you've asked a good question. And convenience is, if you spend time with the retailers, you'll see certainly new solutions to drive customer performance from their standpoint. We've seen a lot of new merchandising strategies, a lot of new ways to deliver value for consumers across multiple categories in convenience. I think it's really important that we play a growth driver role inside the store, and that is delivered across our core innovation and how we deliver value in multiple transactions and things that consumers are doing. I think that there's also new tools that are exciting. So there's loyalty and tools that retailers are using that we're participating in that drive personalization and loyalty. So there's so many new fascinating ways to grow the business. And again, I'm super passionate about this channel and our opportunities to build brand and build momentum in it. It will be a focus point for us moving forward.
Thanks, Kirk.
Thanks, John.
Thank you. There are no further questions at this time. I'd like to hand the floor back over to Nori Naughton for any closing comments.
Thank you, everyone, for joining us this morning. We look forward to our follow-up calls this afternoon. Thanks.
This concludes today's conference. You may disconnect your lines at this time. Thank you for your participation.